So so the principal residence says, let's look at code section 121. Hate to throw numbers at you, I don't either. That's the code section that excludes up to $500,000 of gain when you sell your primary residence. Well, in that code section, there are 2 or 3 little pithy items. One of them defines what a residence is. Generally, I think we'll get to that. It defines that your primary residence is where you live. Now watch the issue there, that the only thing that can be discharged in that $2 million is qualified debt. And qualified debt is the debt that you use to initially purchase, improve, or refinance no more than the balance on those over time. This does not include that $100,000 mortgage deal where you can get a home equity loan up to $100,000. That's not in here. If you did a cash out refinance, if you had purchased your home for $700,000 and later refinanced it up to $800,000, even though it's secured by the home, even though you've lived in the home for the last 5 years, all of those things may come into play, but only the acquisition, the qualified acquisition debt can be discharged under this provision. The rest of it is income, unless we go to code section 108. One of the things we want to be careful about is that under the code section that we say, well, what's a residence? A residence, you have to live that. I can recite this in my sleep now. 2 out of the last 5 years, it had to be your primary place of residence. Well, what happens is we define what a primary place of residence is. And a principal residence is where you live. It's where you do the things people do that live where they live. You get your mail there. You show up there every night. It has eating, cooking, sleeping facilities, all of those things. So that is your primary residence. What you don't have to do, though, for the mortgage debt exclusion, you do not have to meet the 2-year requirement. So you go to see counsel, and counsel says, you're in deep trouble on the house on the other end of town there. If that happened to be your primary residence before a foreclosure action is commenced, you might not get a deficiency judgment. So if you move into that home 2 or 3 months and a foreclosure action is commenced and you have debt discharge income, that is your primary residence for purposes of this act. You may have some problems with your other residence, by the way. We won't talk about that. You can only have one primary residence. There's another little buzzword floating out there, second home. Well, there is such thing as a second home, but not for this purpose. There's only one. And the similar rules apply. The debt must be secured, even though it's qualified personal resident acquisition debt, it must be secured by that property. And the other thing to keep in mind is when you refinance that, if you borrowed $700 to buy it, you paid it down to $500 and refinanced it, the $500 you paid it down to is your qualified acquisition debt. $2 million we've been there. Okay. Ordering rule, this is somewhat interesting. What happens, remember I said that what would happen if you had $700,000 of qualified acquisition debt and you had $800,000 discharged. The last dollars discharged are the qualified personal residence dollars, okay? So what can happen is that you can wind up with taxable income. This may get out. Okay. You have a security of $1 million, $800,000 is qualified. The residence sells for $700 in this case, and there's a full $300,000 worth of discharge. Now, if you look, remember I said the last dollars discharged are the qualified personal residence. Uncle Sam reaches in and said, you only had 800 qualified, and the debt was $1 million, so they say the whole $200,000 difference is fully taxable. We don't get any kind of a proration here. So watch that issue. If you have clients that owe more money on those primary residences than their purchase basis or that acquisition debt is, they have a little heartburn ahead of them. However, here we go. Insolvent taxpayers can elect to have the new mortgage forgiveness apply ahead of this. We'll come and talk about that in a moment. Remember, the second homes, motor homes, business property, credit cards, those are not eligible for this Debt Forgiveness Act. $400,000 mortgage, the bank reduces it. They do not take the home. They reduce the mortgage to $350,000. That is really one of the primary poster children for what this act was supposed to help with. Was a homeowner who stays in their home and gets assistance through either a mortgage reduction or a modification of payments. It is not taxable income. And by the way, again, these are statutory. You don't make an election. You don't have to hold your mouth just right to get these deductions. They are in statute. In fact, in theory, you don't have a choice. It's the way it works. The IRS has a foreclosure worksheet, and actually some of these worksheets work fairly well. We can, that help you work through how much of a debt is excludable and how much would be taxable. Mea culpa. I have a debt discharge. It looks like it's taxable. What do I do? Back to the code section. 108 has one of those mandatory provisions. If you have discharge of indebtedness income and you are an insolvent taxpayer, you do not pay the tax. You do not include that in income. So now, it's like a lot of other code sections. Anybody ever heard of 1031? They were fun for a while. Believe it or not, that was not an election you made. That was in the code. If you exchange property, gain is deferred. Well, we have the same thing here. Now, we may do a lot of things to see if we can't fit this, but it's just in the statute. As you can imagine, the code has a very funny definition of insolvency, but it is fairly logical. In the code, they start with liabilities. I don't know why, but it works. What happens, you add up all of your liabilities. There's a pretty good insolvency worksheet that if anybody wants, I can send to you on email. If you're working through with clients on the issue and they bring up the point that isn't there something about that not being able to pay your bills or something, yes, it's insolvency. One of the things that happens though, this insolvency exception to including debt discharge income has to be calculated every time there's a discharge of indebtedness. If you compromise some credit card debt in April and believe you're insolvent, you should calculate the insolvency calculation at that point. If you go down the road and you have a debt discharge in August on a real property and you believe you're insolvent, you have another insolvency calculation to go through. Now, once you set it up, it's fairly easy to roll through. But what you do is you list every debt you have, recourse, non-recourse, including the debt related to the property that is being transferred or foreclosed. Then you list all of your assets. Now, the IRS is an interesting thing. When they go through their debt insolvent, they list computers, notebooks. I mean, it's an amazing thing. Don't go to that level. In theory, you're supposed to. You're supposed to list every item of personal property you have, every asset that you have, including the property being disposed of. But be careful in this one. You also list all properties that are not subject to the claims of creditors. Retirement accounts, cash value of life insurance. Now, well, anything that you have that has value goes on the asset side of this.